But I think the volatility makes sense given the move that preceded it. I think it's a huge breakout in silver. I think silver prices are headed substantially higher from here. I think a lot of this volatility will ultimately, go away. And I think we'll see a far more orderly appreciation of silver, maybe something more similar to what was going on with gold up until the recent volatility. And I think the bull market in gold is going to persist. Gold is only about 10% off its highs. So, nothing like silver down 30, 40% from its highs. So it's just a normal correction in the silver in the gold bull market. But I think what happened in silver is a very rare event, but it coincides with something that was also rare, which was this massive breakout in silver. So I think it's very bullish for the metals, and even more so for the miners. I think the precious metals mining companies are even cheaper. And Wall Street is still not woken up to that reality either. Well, I think, buying gold anywhere below or close to 5,000, I think still makes sense. I don't think there's significant downside risk. To me, gold is acting around 5,000 the way it acted around 4,000, the way it acted around 3,000. But also, buying gold at 5,000, you're getting it 10% below its high. So that is a decent correction. Does it mean it can't go to 4,900 or 4,800 or 4,750? No, it doesn't mean that. But who cares? Right? If you're buying gold as a long-term store of value, it doesn't matter if after you buy it, it gets a couple of $100 an ounce cheaper. In fact, you could always buy more. As far as silver, I expect more volatility. So silver, as we're talking, is just below 76. Yes, it could easily fall below 70, and so you'd be down close to 10% on paper if you bought some here. But again, I wouldn't worry about it. I don't think silver's going back down below 50. In fact, I don't even think it's going to get anywhere near 50. So I think we're not that far. Maybe the upper 60s or low 70s is maybe about as cheap as you can get it. But the other problem you have is that physical silver is getting harder to procure. So the premiums that people are paying now on silver coins and bars, especially low denomination, are higher. So even if silver goes down $10, it doesn't mean you'll be able to buy it $10 cheaper if you actually want physical. So you've got two things working there. You've got, the scarcity of the physical metal. Yeah, if you want to buy a futures contract, you may be able to buy it, but buying a futures contract is not the same as getting metal delivered to your door, which is what we're doing at Schiff Gold. So I just tell people, just buy whatever we got while we have it in stock, because I can tell by what's happening in the market that we're going to run out at some point. It's going to be hard to get silver, real silver, because I think there's been a big disconnect between the paper market and the real market. And eventually that's going to resolve itself with the futures moving higher. But in the short run, the futures price could do whatever it's going to do, but the physical market is limited by the actual supply of deliverable silver and the demand for that silver, which is growing, not just by investors, but by industry that needs silver. So if you're making batteries and the batteries need silver, you can't just buy a silver contract. You can't put the contract into your battery. You got to actually have real silver delivered to you. So you have to buy it in a physical market.
Is that, though, more of a supply chain issue within the precious metals space, or is there really a silver shortage? Like, people use that word silver squeeze constantly and maybe misuse it as well, because you have access and you have insights into what's happening on the physical side in the supply chain.
Yeah, well,
is it a supply chain issue or really a squeeze?
Well, it's both, because, there's a constraint on how much silver can come out of a mine. There's only so much the mines can produce. They just can't turn on a new mine just because silver is higher in price. They just can't say, oh, let's mine more silver. Most of these miners were already mining as much silver as they could. at the older prices, but also has to do with the refiners. If they run out of inventory, they can't magically transfer bullion into coins and bars, the raw silver. So if all of a sudden there's a big increase in demand by investors, they just don't have the capacity to immediately supply it all. So you get a backlog and you get delays. Then obviously people will start to pay more money for a more immediate delivery of their metals. So all these things are happening. I mean, I can tell you at Schiff Gold, business was very slow for the last several years. It just picked up a lot in the last month to the point that we've never been this busy. But to go from a very slow, environment to all of a sudden busy, well, you don't have the manpower. You don't have the resources. You're not used to it. All of a sudden, there's a big increase. And that's not unique to my company. Obviously, it's happening all over the industry. So, yeah, we've hired some more people. We're ramping up to deal with it. But, there's going to be problems throughout the entire distribution channel when all of a sudden there's a lot more demand for the metal.
Absolutely, yeah. As you said, you can't ramp up, and I hear the U.S. Mint is usually not the best producer, especially when it comes to the American Eagle. They're lacking behind massively as well. So, been hearing those rumors for quite a while now. Peter, you touched on the miners, and we need to talk about them. Big opportunity here. They have been lagging the precious metals for a while. Caught up. Now the precious metals have dropped. What's the situation here for the mining companies? Is there still room to run, and what's the opportunity here?
Yeah, I mean, there's a lot of room. Wall Street has pretty much been skeptical of the gold rally ever since 2000. So the whole time gold was going up, Wall Street was expecting it to go down. In fact, if you go back to early 2024, when gold was at 2000, major banks that cover mining companies were putting seller recommendations on Newmont and Barrick. And the rationale was gold has peaked at 2000. There's no upside. And so why own these miners when all that's going to happen is the price of gold is going to go down? And so these companies have never really reassessed that bad conclusion. And so they've watched gold prices more than double since that forecast, right? And even though the gold stocks have, let's say they've tripled as gold went from 2,000 to 5,000, and that's a little bit more than the increase in the price of gold, one would have expected a lot more than that, given the magnitude that $5,000 gold has on their earnings. Your earnings don't just triple when the price of gold triples. Your earnings move up by a much greater factor than that. If your cost of mining gold is $1,500 and the price is $2,000, you're making $500 an ounce. But if the cost goes to $5,000 and you're still at $1,500, right, you're making $3,500 an ounce. That's 7 times the profits. On not 3 times. So there should be a lot more leverage because these companies are inherently much more valuable today. But it's not just that gold is at 5,000 today. It's that it's going to be much higher tomorrow. Wall Street still doesn't get that gold prices are going to keep rising. Not only are gold prices not going to fall, they're going to keep going up, which means the earnings that are already not being properly attributed to these companies and valued are going to go even higher in the future. So I think you still have a great opportunity to buy these companies. And in fact, some of the best opportunities are in the juniors, the real juniors that haven't even moved as much as the senior stocks. And there, the opportunities are incredible because I think a lot of these small companies are just going to get bought out by the big companies that have massive cash flow now. What are they going to do with all their money? I mean, they could jack up their dividends a lot. They could buy back a bunch of their own stock, or they could try to accumulate more reserves so they have more gold to mine. And the easiest way to do that is buy up smaller companies that have a lot of reserves, proven, but that don't have the cash to develop them, and just buy up those reserves and just, put them on ice, or, you don't even have to develop them now. Just hold on to them, because you don't have an infinite supply of gold. So, just keep them for the future, because the gold's only going to get more valuable. The longer you wait to mine it, the more it's going to be worth. So some of these smaller companies may need to mine the gold now because they have obligations. But if the big companies buy them up, they don't need to mine it. They'll just throw it in there, and it'll just be valued as part of their reserves. They got more operating cash flow than they know what to do with right now. They've never been making money like this.